All right, we're going to go over one of my most profitable strategies, the engulfing candle strategy. This is a strategy to where if you don't have a lot of time, you can actually profit really well in the markets and be able to trade Forex properly with this strategy. So let's get started. So the main things that you have to understand is that one, with price by is moved by the banks or hedge funds. So other institutions that are have large capital. Price is not moved by traders like you and me. Price doesn't care about traders like you and me, but price is moved by the banks or hedge funds. But you don't know exactly what they're doing or what levels they're interested in. But there's one key strategy, one key indicator or clue that you can use and you can spot to where you can see that there's interest at this level. We're taught to look for, highs and lows and stuff like that, which is true, but it's not the whole story. And let me show you why. Because you want movement in the market. You want movement to pay you because that's the only way you get paid is if price moves. So how do you find the movement? Well, you look for areas in the market where the movement has been already displayed, and that's with engulfing candles. So if you look here, you see how when this engulfing candle started, this engulfing candle moved the markets. And basically, what an engulfing candle is, to illustrate it for people who don't know, engulfing candle is when you have one candle that basically engulfs the other. So you have it's a two candle formation. So if you look at this, I'll illustrate it with these two rectangles. An engulfing candle is a smaller candle followed by a bigger candle of the opposite trend or the opposite movement. So if I have a green candle, for an engulfing candle to form, I must see a red candle or a selling candle that's body is bigger than the previous candle. You can have, little wicks. You can have little wicks like that, but that's not the main thing. Your main thing you're looking at is the body of the candles. If the body of the candle is bigger and larger than the previous candle, that's an engulfing candle. So, for example, an engulfing candle, an easy one to spot out would be this one here. So, if I zoom in, you would see that this candle here is an engulfing candle. So, right here, this candle there, it engulfs this white candle and continues up in the upward direction. See how the bodies are very different? That's an engulfing candle. So when you're looking for candles, and right here, this is also an engulfing candle because this is a white candle. The green candle was in a different direction and it engulfed the entire movement of the white candle, also engulfed the movement of the two candles before it. This is a true engulfing candle. This is a true engulfing candle. So you want to train your eyes to look for in candles like that. Why is engulfing candles so important? Because for price to move, somebody has to place a large enough order to influence price. And who can place orders like that? Large institutions, banks, and hedge funds. So when you look at these engulfing candles, these are where banks are placing their trades. So if you know how to spot these, you know how to think about it, you can game plan for it. So let's go back to the strategy. So now that you know what engulfing candles are, what is the strategy? So the strategy is to know where banks' interests are at. So to know where banks are planning on making their moves. So, how do you do that? Well, one, you're still going to trade with the trend. So, the first thing would to be to do would be to find the trend. So, find the trend. And the best way to do that is one, you can look for, if you're more advanced trader, you can look for higher highs and higher lows, but you see stuff like this and that can confuse you. So the way I recommend looking for trend, especially when you're just starting, is to use something called a moving average. Now, I'm not going to go into exactly what moving averages are, but it's basically just the average of price. That's all it is. And it's used to find support and resistance and also identify trend where you're using multiple moving averages. So let me show you how that works. So when I go in my trading view and I go to indicators, I just type in EMA. It's going to show you moving average exponential. I'm going to put 2 of them on my chart. So the first one, I'm going to go to settings here. I'm going to change the length to 10 and I'm going to make that green. And then I like to make it a little bit thicker. The second one is 90 and I like to make that red. Make it thicker so you can see it easily, because you want to be clear when you're trading. You don't want to be squinting and using extra energy when you trade. So with the trend using the moving average, this is how you figure it out. If the green line is above the red line, it is an uptrend. If the green line is below the red line, it is a downtrend. So you see here, that was a downtrend. And then you see here, after that, it continued up. So it continued up from that point after the moving average crossed. So you have your uptrends and downtrends. So now the second thing is, when it's in an uptrend, you're looking for buys. And when you're in a downtrend, you're looking for sells. So now that you know what you're doing with the trends, this is how you look for your trades. So what you do, we're going to start here where this uptrend started. You're going to go and you're going to stay on the 1 hour chart to start off. You're going to go and you're going to wait till you see an engulfing candle. So if I zoom in a little bit, where is an engulfing candle form? So I go here, I look for an engulfing candle. That's close. It's not an engulfing candle. Oh, here we go. Here's an engulfing candle. So the first part of the trade, the second part of the trade is to find an engulfing candle. So to recap, find the trend, find an engulfing candle that goes with the trend. Then what you're going to do is you're going to look for sharp movement in the direction of the trend. Look for sharp movement in the direction of trend. So you got your engulfing candle. Now you're looking for sharp movement in the direction of the trend. So basically, sharp movement is something like this. It doesn't have to be this long of movement, but where a price moves and goes in a direction pretty quickly. So you see here that after this uptrend, after this engulfing candle, price had moved, it moved all right. So it still moved, it slowed down, but it still gave you a little bit of a sharp trend. A small sharp trend. It barely counts, but it still counts. So now you got your engulfing candle. You got your sharp movement up. The engulfing candle can count as the sharp movement up if it's a big enough candle. So that was a pretty decent sized candle. So that can count. The next thing is you're going to wait for price to return to the open of the engulfing candle. So the opening price. So that's the fourth step. So what do? The best way to do this What I like to do is I like to place a line. So if I'm doing a buy trend, I like to use like the horizontal array line. And if you want to get close so you see exactly what you're doing, you're going to put your line right there. And I like to make it green so I know I'm buying. Or you could place a buy trend. So you wait for price to return. Now in this example, price had hit the open of the engulfing candle perfectly and rejected from that. Had you bought that would have been a very easy trade to win. I'm going to show you what the ramifications for your risk are. But you can see that was a very powerful entry point. Now, what you do, let me zoom back out. So what you do when price hits that entry price is you're going to take the trade. So take the trade at engulfing candle entry. So once you take the trade, now on the hour chart for pairs that are not, so non-GBP pairs, this is what you're going to do as far as risk management. You're going to have a 25 pip. You're going to take two trades. So you're taking two trades. So like twin trades. So basically you place the same trade twice. Take two trades. The first trade. So first trade has a 25 pip take profit, 25 pip stop loss. Second trade, it has a 50 pip take profit and a 25 pip stop loss. So non-GBP pairs, because GBP pairs move really aggressively and they move a lot. So 25 pips is not enough space for a GBP pair. You might have to do 40 and 40 and 80 and 40 for your second TP. So for a GBP pair, you would do 40 and 40, and then you would do 80 for your second trade and 40 for your stop loss on the second trade. Something like that. So you can give the GBP pair more space. Also, Euro AUD also counts in this category as 40 and 40. So for pairs that are not those pairs, you can do this. Now, the next thing is in the moment risk management. So if trade is 10 pips in profit, bring stop loss to break even. So what I mean by that is, say once this gets 10 pips in profit. So if I measure this out, 10 pips is about that. Yeah, it's went up 70 pips. So 10 pips is about that. So as soon as it went 10 pips in profit, I bring my stop loss. I'm going to let this red line represent my stop loss. If I was 25 pips in stop loss here, I'm going to bring it to break even. So now I'm not risking. It's a risk-free trade. You want to get to where you have risk-free trades as soon as possible. So you see that, your stop loss is at break even, and now you can breathe. What happens after that is either you're going to win the trade or you're going to stop out at break even and not lose any money. It's a great risk management. That's very key. It can ruin your entire profitability if you don't do that step. So if I keep going here, I see that there's another engulfing candle. Another engulfing candle here. I'm going to put a line at its entry price, at its opening price. That's going to put me right there. Now, you see how price went there. See how it didn't go that much, in drawdown. It went, let's see, it went 11 pips, 10 pips in drawdown. Did it go up to 25 pips? No, it went to about 20. So what would have happened? You would have went up 10 pips and your stop loss would have been brought up to break even. And that would have been a break even trade. So basically you're taking these trades until the green line, you're taking the buy trades until the green line crosses the red line to make it a selling trend. So as long as you're trading within trend, you're going to have high profitability. So this is my engulfing candle strategy. And with this strategy, you'll know how to trade Forex in 15 minutes or less.